this topic here is about how inflation, deflation, like trends and relations to business cycles affect portfolio return forecast. So basically, this is the first table. I summarized how at different stages of a business cycle, there are 5 stages according to CFA level 3 material. And then I look at economic indicators and capital market variables, how these 2 categories are being affected. So this is a summary from last class. So basically, what I wrote here is how explicitly stated in the textbook, how at different stages, like each economic variables behave or may behave. So what we should realize is that very often the relationship here are not very well documented academically or like with a very definite relationship, but there is a high probability that you will observe such kind of relationship. So in this chapter, the focus is how inflation or deflation is behaving at different stages. So as we can see from here, there is like for here we can see at different stages. First, how inflation at initial recovery, like it's decreasing, and at early expansion, say maybe deflation, maybe or it's started easing, but it's not explicitly expressed out. Okay, or we say, and then the monetary policy will be withdrawn because the I guess the inflation might start increasing, etc. But what is obvious is during late expansion, the inflation is accelerating very fast. There will be kind of wage pressure, etc. So then here there is, of course, it's not clearly mentioned how inflation deflation is changing. So it's kind of a gray time. And then the during the end, like contraction period, we see decelerate. Inflation is decelerating. Okay, so it's not necessarily deflation. So it's decelerate inflation. So and also there's some kind of multiple choice question in the curriculum. So the multiple choice question says in the text says, okay, Taulier states the economy is likely in the early expansion phase of a business cycle based on yield curve, and consistently with this phase of a business cycle, monetary policy is becoming less stimulative. So the question like answer is yes, it's correct, because at early expansion, based on the knowledge base of the textbook, that's what been pointed out. At the early expansion period of the business cycle, stimulus policy will be withdrawn. You can see the practice question is closely tied with the textbook. So first, there is some kind of theoretical addressment at the beginning of the chapter. Is saying money is backed by the credibility of government and central bank nowadays, instead of physical money like gold in the past. And the analysis, this was raised in the end of the textbook, but for those who have studied macroeconomics, see how business cycle has been caused. So this model is assuming short-run aggregate supply curve is sloping upward, business cycle is directly driven by demand side. So for those who study macroeconomics, you can see it's not as simple as that. So then it started with two differentials in terms of the economic behavior has asymmetric results. Central banks' policy are more effective in slowing economy than stimulating the economy. So that's why central bank may tend to be more aggressive in combating downward. That's one differential. Another one is, say, inflation. Moderate inflation has moderate cost. Deflation damage the economy seriously could. So that's why, in terms of central bank policy, is targeting positive inflation. So the result is that, in general, we expectation of inflation is built in the economy participants. So inflation is a pro-cyclical. So what does pro-cyclical mean is that it will accelerate in late expansion and decelerate in recession or initial recovery. So when the central bank is credible, so the average inflation should be, on average, the inflation, should be equal to the target inflation. So the expected inflation, is also pro-cyclical, But here it's a very interesting new concept, new for me. It says it's based on horizon. So what does this mean? So when it's late expansion, the expected inflation is high, and in recession, the expected inflation will be low, etc. However, so it says at different time of business cycle, the horizon structure of expected inflation. So this is a new concept. What do we mean by horizon structure of expected inflation? Because there is a short-term expected inflation, the long-term expected inflation. This is similar to the yield curve concept. See, it says when the economy business cycle is at trough, we see there is upward sloping of a horizon structure of expected inflation. And when the economy is at peak for expected inflation, the longer expected inflation is actually lower than the short term. So, however, it's pointed out, this is notes in the text, but it says inverted horizon structure not necessarily implies inverted yield curve due to term premium. So although the expected inflation for longer term is dropping, but that's not necessarily the overall nominal interest rate is going to be downward sloping, because longer term bonds generally demand a term premium. So how does inflation impact investments? So it's talking about 4 categories of investment: cash, bonds, stocks, and real estate. So in terms of overall theory of this chapter, it says inflation impact investment through two channels. One is how does it impact cash flow. Another one, how it affect discount rate. So in terms of cash, how does it affect cash investment, or how inflation will affect our prediction for different type of investment. So here when we talk about cash, it's short-term interest rate bearing instruments such as 3 months TBO or 3 months CDs, etc. So these are considered as inflation protected because a short rate can adjust with expected inflation. Okay, so in terms of a central bank policy, here I said it's not clear in the writing because for me I find it's a little bit confusing here in the textbook. So it says the real rates is pro-cyclical. Okay, so that means the real interest rate is high during the expansion and low during the recession. So cash is attractive when interest rates are rising and not attractive when interest rates are declining. Okay, so this is what the text says. And it says cash is attractive in deflation when there is a zero lower bound. This is relatively easy to understand because cash will not, will still keep the face value and the purchasing power will increase actually in deflation time when there is a zero lower bound interest rate. So for bonds, okay, the cash flow is fixed. So discount rate is the only thing that change due to inflation. So here again, the question you might want to ask is how do you decide the deflation discount rate? So this is we are going to look at the models using the textbook to find out expected return. So generally, we think if the inflation increase, deflation discount rate will increase, and there will be capital loss. So if inflation is within expected cyclical range, short short interest rate will actually changes more than long-term rate. So otherwise, if inflation is out of the expected cyclical range, okay, so basically there is unexpected price change, then long-term interest rate. So I often use Y here means like Y long change more sharply. So when there is a persistent deflation, it will benefit high quality bonds, may impair low quality bonds. For stocks, if inflation is equal to expected inflation, in fact, because it's already built in the forecasting for cash flow and the discount rate, so then there won't be any effect on stock price. So this is a very interesting concept in studying macroeconomics, is the expected inflation is if it's already built in, okay, in the current inflation actually won't affect the other variables. It is like won't lead to the change of economic variables. But if the real there is a surprise, okay, in the economic variable, for example, if inflation is greater than expected inflation, the central bank need to slow the economy. So that could lead to, like, if the inflation, then that means the interest rate can drop, like the market will revise based on revise the expectation. Maybe they think, okay, central bank will drop the interest rate. So if the inflation is high, so that could lead to the market react to that information. So if the inflation is less than if expected inflation, that means there is okay, sorry, maybe I made a mistake earlier. So central bank need to slow economy. That means they might need to increase the interest rate. Okay, so if inflation is high, the market might be reacting, so the stock price will drop. And if there is unexpected high inflation, if there is unexpected low information, inflation, then that means the asset price is overall dropping. That means the central bank might, the market might expect the central bank to reduce the interest rate. So higher inflation generally benefit firms that can pass along the rising costs, such as maybe grocery stores, okay, like commodity firms, etc. So that's why generally when there is a high inflation, these firms are doing better. So deflation is bad for asset-sensitive, commodity-producing, and high-leveraged firms. So why deflation is bad for asset-sensitive, commodity-producing, and highly leveraged firms? Because, okay, asset-sensitive firms like real estate infrastructure, this value will drop. As we can often see, that's why it's deflation. And of course, falling commodity price. And why highly leveraged firms will suffer? Because when there is a deflation, their real value of debt is going to increase. Okay, so that's the impact of inflation on stock. So how inflation will affect real estate investment? So in terms of real estate, renewal of leases, okay, is like how the lease is structured under different real estate will affect the value. Okay, so when there is a rising expected inflation, renewal of leases likely will require higher income. So if that's the case, like higher inflation means higher income, there will be stable value. However, if the real inflation is different from expected inflation, for example, if the inflation is greater than expected inflation, so what does that mean is the demand, okay, the demand for real estate will increase. So that means the value of real estate will increase, okay. However, this increase is having larger variance, okay, depending on different properties. Real estate has like different length of a lease substitute, or how quick, basically how quick you can provide this kind of new demand. However, if inflation is less than expected inflation, then the value of the property will drop, especially the less prime real estate properties.